So last time we were looking at lessee accounting. We solved a question where the lessee have the option to terminate the lease after 4 years, but the lease period is 6. The lease period was 6 years. So we are saying that whenever there's a termination clause in the lease and the lessee is certain of what's terminating the lease, then the termination period or the the time after the termination will now become the lease period. So the lease period was 6 years, but the lessee has the option to terminate the lease after 4 years, and they were certain that the lease will be what? Will be terminated. So the lease period will now be 4 years, not the 6 years. So we look at a question like that. And there was also a second question on that particular one. So we are going to deal with that second question before we move on to the sell and lease back. We deal with 2 questions there. Then we look at the reassessment of lease liability, also 2 questions. Then we go our separate ways to go and do whatever we want to do for the day. All right. So I will share the question and the screen with you guys so that we move on. Okay. I hope we can see the question on the screen.
Yes, sir.
Okay. So this is the question that we are going to deal with. So someone should take it for us. Someone should take the question for us.
Okay, sir, let me take it.
Okay.
On 1st January 2020, Debtor Limited, DL acquired a machine on lease from Lifebuoy Leasing Limited for 3 years. The first annual installment amounting to 35 million was paid on 1st January 2020, and all subsequent annual installments are payable on 1st January, subject to increase of 10% each. DL incurred initial direct cost of 5 million as an incentive to DL for entry into the lease. LLL reimbursed 2 million. LLL has incorporated an implicit rate of 11% per annum, which is not known to DL. The residual value of the mechanic at the end of 3 years is estimated at 30 million, out of which DL has guaranteed 20 million. DL is also obliged to incur decommissioning cost of 4 million at the end of the lease term. Discount rate of 12% may be assumed wherever required but not given. Required, prepare relevant extract from DL statement of profit or loss for the year ended 31st December 2020 and statement of financial position as on that date.
Okay, thank you, Senior.
Thank you, sir.
This is a lessee accounting. This is an example of lessee accounting, very simple example. We can see that there are some things that are new here. The first one is the increment in the lease liability, which we are not really familiar with. We can also see there is an issue of decommissioning costs, which we all know about. We know that if you are looking for IS-16 property, plant, and equipment, especially the mining companies, they will come for the land as part of the agreement. The forestry commission or something like that, they will ask them, or the land commission, ask them to what, to reinstall the land to its original position after the concession period. So they are going to incur a decommissioning cost. Why are they incurring this decommissioning cost? Is because they want to lease the land. So if not for the land, or if not for them leasing the land, there will not be any issue of that decommissioning cost. So we assume that the decommissioning cost is as a result of the lease. So it's a direct cost as a result of the lease. So the decommissioning cost will be added to the initial cost of the assets. But what value do we add is the present value, because the value given to us over here is the value that we are going to incur at the end of the lease period, which is the 3 years. So we are going to pay 4 million at the end of the third year. But if we should carry out the decommissioning cost today, what should have been the value? So we find the present value of this and add it to the asset, which is the rights of use. Okay. They are asking us to prepare relevant extracts, which will be the profit or loss and statement of financial position for the year ended 31 December 2020. Okay. The issue is what is the date for the agreement? What is the date for the lease agreement? At what date? What date are they striking the lease agreement? What is the date? The date for the lease agreement is what?
1st January 2020.
Okay. So at 1st January 2020, how are we going to recognize this transaction in the books of the company? So at the time of the agreements, the inception period or the date, how would the accountants record this transaction in their books? So that is what we are coming to look at, the initial recognition. How do we record this particular transaction at the date of the agreement? What we have to do is that we are saying that the Debtor Limited will be paying what, 35 million at the beginning of every year. This is payment in advance. So they are going to pay 35 million at the beginning of every year. So the question now is, assuming we have the money today to pay these people, how much should they have given to them for the 3 years? Because we are paying them 35 million at the beginning of every year. So if you have the money today, how much should they have paid them? So you have to look for what? The liability, the lease liability. So you are paying 35 million at the beginning of every year. If you should have the money today, how much are you going to give to those people? Okay. Or currently you are owing the people, which you are going to be paying at the beginning of every year. How much should have been the amount that you are owing today, which is the amount that you should have given today if you have the money? We do that, then we look for the rights associated with the assets, the maintenance associated with the asset, the insurance associated with the asset has been transferred to the lessee. So within the lease period, the lessee will be the what? The owner of the company, of the assets, of the machine. Because insurance, everything associated with the asset, possession, ownership, and those things have been transferred to them. So they have to be the owner. They are going to act as if they are the legitimate owner of the asset within the lease period. So we are going to estimate our lease liability. So let's come to the initial recognition. So initial recognition, which is at the date of the transaction, what are we going to do? So the first thing is we have to recognize the lease liability and right of use. How do we calculate the lease liability? The lease liability is the amount that we are here to pay. So we calculate the lease liability on the amount that we are here to pay. So we present value the amount that we are here to pay. So let's come here. Let's come to the question. So you can see that we are paying 35 million at the beginning of every year. So it means that at the date of the agreement, we have already paid the what? The 35 million. So we are not owing them any amount for this particular year. But we are going to pay 35 million for the remaining 2 years. So those are the amount that we are here to pay. So the first year, which is 2020, the first year, which is 2020, we are paying 35 million. Okay. 2021, how much are we going to pay based on what the question is saying? Okay, the first annual installment amounting to 35 million was paid on 1st January 2020. That is the date of the agreement. All subsequent annual installments are payable on 1st January, subject to increase of 10% each year. So 2021, how much are we going to pay? How much are we going to pay?
38.5 million.
38.5 million. So 38.5 million. That will be 1.1 times 35 million. So we increase it, we find a 10% on that. 2022, how much are we going to pay?
42.35 million.
42.35 million. So we increase 1.1 times 38.5. So every year, the lease liability will increase by 10%. So we have done the increments. So this is what we are going to do. But we have already paid this one. So these are the ones that we are here to pay. So this is what we are going to use to determine our lease liability at the date of the agreement. So let's determine our lease liability. So the lease liability will be calculated as the present value of the rentals that you are here to pay. So we have the years here. We have the cash flow. We have the discount factor. Then we have the present value. So the first year will be 2021. The cash flow is what? 38.5 million. The discount factor is the interest rate implicit in the lease, which is the 11%. So if the rate implicit in the lease is not available, we use the what? The borrowing rate of the lessee. But this one we are giving that particular one, so that will be 11%. Okay. So let's find the discount factor for that particular one. Let's count to 2022. 2022, our rentals will be 42.35, but we have information concerning something there. Okay. The residual value of the machine at the end of the 3 years is estimated at 30 million, out of which DL has guaranteed 20 million. So the residual value of the asset at the end of the lease period is what? 30 million. But DL is telling what? The lessor that they are going to pay 20 million out of that. When are they going to pay the 20 million? It will be at the end of the lease period, which is the 3rd year, which is the 2022. So they are going to pay 20 million in addition to what? The original what? Rentals. So in 2022, our liability there or our cash flow there will be the 42.35 plus the 20 million, which is the what? The guaranteed residual value that they are saying that they are going to give to the lessor at the end of the lease period. So our 2022, the rentals or the amount, the cash flow will be 62.35, which is the rentals of 42.35 plus the guaranteed residual value of the 20 million. All right. So let's calculate the discount factor for them one by one. 11% for the first year. What will be the rate? 11% for the first year.
0.90.
0.90.
901.
Okay, 0.901. The second year will give us what?
0.81.
0.8.
One.
Yeah, it should come 0.8 what?
1.
12.
Yes, it's 1.
Okay, so let's multiply now. So what will be the present value for the for the first year? 38.5 times 0.90.
4.6885.
Come again.
34.69.
34.69. Okay. The second year is what?
50.63.
50.63. So the total is what?
Is 85.32.
85.32.
32.
Okay. So this is the lease liability. This is the lease liability at the beginning of the 2020 year. Okay. The next thing is that we are going to do maintenance of the assets. We are going to do everything for the assets. So within the lease period, it is as if the asset is our own. It is as if we are the legitimate owner of the asset. So the lessee is going to recognize an asset, which we call the right of use, So we are going to recognize the right of use. So the right of use will consist of what? Let's come. So the right of use. Okay. So the right of use consists of what? How much are we going to pay? How much are we going to pay to the lessor as of today? How much are we owing them?
5.3.
Okay, we are owing them 85.32. Why are we owing them this amount of money? It's because of the asset that we are leasing, isn't it? So all
Yeah.
things being equal, we can say that they have sold the asset to us on credit, and the value is what? 85.32. So it means that the value of the asset is 85.32 as of today. The assumption is that we have bought the asset from them on credit. Okay, you are owing me 85 million. Why will you be owing me? It means that you have taken something from me. So what you have taken from me is the same as what the cost of what you have taken from me might be the same as the amount that you are currently owing me. So the right of use, the first item that will come is the lease liability, the the present value of the minimum lease payment. So the first amount that will come is the lease liability. So let's take that, which is the lease liability. So the lease liability will be 1, which is 85.32. Okay. The issue now is I've given you something. You have given me 10 million already, but you are still owing me 100 million. So it means that the total value of the thing that I've sold to you is how much?
110.
110. Okay. So you can see that in the question, the lessee has already paid what? 35 million, isn't it? They have already paid 35 million. Because the lease liability is calculated on the amount that they are here to pay. But they have already paid 35 million. We didn't take the 35 million into consideration the time that we are estimating the lease liability. So we are saying that the amount that they are currently owing is 85.32. But already they have paid 35 million. It means that what they are buying is the amount that they are here to pay plus the amount that they have already paid. So the 35 million will be added to the lease liability, like the example that I've given over here. You are currently owing me 100 million, but you have already paid what? 10 million before you are owing me 100 million. It means that what you are getting from me actually worth what? 110 million. You have paid 10 million and remaining what? 100 million. So The lease liability, we take the right of use, we take the minimum or the present value of the minimum lease payment. If there is any initial deposit or any advance payment, they are all making this advance payment and deposit in relating to what they are leasing. So the advance payment of 35 million will be added to get the assets. So advance payment of 35 million will be added. So let's come to the question. There is an other items there. Let's pick them. Let's pick them. Okay. So DL Limited incurred initial direct cost of 5 million. As an incentive to DL for entry into the lease, the lessor reimbursed 2 million. The LL has incorporated the 11%. Okay, we are aware of the 11% already. So they say the DL has incurred initial direct cost. This initial direct cost can be installation cost for the assets. It can be delivery cost. It can be handling cost. It can be site preparation. All those costs that are directly incurred to bring the asset to each stage that the company wants to use it, to the stage for its intended use, are the initial direct costs. But just that they don't qualify them. They just put them together and say the initial direct cost. It can be installation cost. It can be handling cost. It can be testing cost. It can be site preparation. It can be any of the direct costs that the company is going to incur to make the asset ready for its intended use. But the cost is 5 million. But what is happening? The lessor is giving them 2 million back. Is reimbursing 2 million back because of the unguaranteed what? Residual value. So they know that there is, at the end of the lease period, they are going to sell the asset for a certain amount. So what do? We have to treat you well so that we can take a good care of the asset, so that at the end of the lease period, we can get the asset in a condition that we want it to be before we sell. So the reimbursement of the initial direct cost is an incentive to make sure that the lessee is taking a good care of the assets, so that at the end of the lease period, the lessor can get the asset and sell it for the residual value. So the initial direct cost, it can be any cost that the company has incurred to bring the asset to a stage that it will be ready for use. So it was actually 5 million, but the lessor has given them 2 million. So it means that the net initial direct cost will be the one that we are going to capitalize. So that will be 3 million, because it will be 5 minus 2. So we add the initial direct cost. So the initial direct cost, which can be any of the cost to bring the assets, that will be 5 million minus 2 million, and that will be 3 million. Okay. Another issue is the decommissioning cost. So the decommissioning cost, we are incurring these costs as a result of what? The machine that we are leasing. So it's a cost that we are going to incur as a result of the leasing of the machine. So we treat this as a direct cost. So that is a cost that we cannot avoid if we want to continue to lease the asset. We are going to incur it. So we find this, but this is 4 million at the end of the lease term. So we are going to incur the 4 million at the end of the 3rd year. But we want to recognize the transaction today. What value are we going to put in our books? So we find the present value of the 4 million, the decommissioning cost, and add it to our assets. So let's go there. Let's find the present value of that. So we have the decommissioning cost here. This is accounted for in accordance with the how did they write the decommissioning? Okay, decommissioning. So decommissioning cost, which is accounted for in accordance with 37. So what we are going to do is that we find the present value of the 4 million, and the present value is going to be calculated as 4 million divided by 1.12 exponent 3. Okay, so how do we get the 1.12? Okay, that is the discount rate. The discount rate that we are going to use is the 12%. So we use the 12% to what present value the 4 million. So what are we going to get? What are we getting? Seniors, what are we getting for that?
2.847.
2 points.
847.
Okay, let's make it to the 2 decimal places. So 2 points.
85.
Okay, 65. So let's now put our right of use together, and then we look at subsequent measurements. That will be after initially recognizing these values, what will happen? So we do for the list, then we do for the right of use and the decommission cost. So what is the total value?
I'm getting 2.85.
Is this I can't get a figure.
I'm getting 2.85. I don't know
2.8
if
for
it, yes,
for the decommissioning cost.
yes, please.
Someone should confirm
Yes.
that.
2.5.
Okay, so it's 2.85. Okay, so 2.85. So let's put the figures together. Let's put the figures together.
The set with the interest rate.
The interest is what?
Interest rate we use. You see, we have the 11% and we have the 12%. So at what point are we supposed to use the 11%?
The 11% is for the lease. The 11% is for the lease. Is the because the money that you are currently owing the lessor, if you should have given those money to the lessor will put that money somewhere and they will be getting a return of 11%. So the 11% is the rate that they have considered because the money will be with you for some time. They are going to consider time value of money. And the time value of money means that the value that the 35 that you should have given the 35 then today, the same 35 will not be the same value if in terms of what you want, purchasing power will not be the same value at the end of the year. So the 35 is going to increase, or the value of the 35 is going to increase by 11%. So that will be the rate that the two parties are going to agree on. So the rate implicit in the lease will be the one that we are going to use to discount the rentals and any other necessary payment that the lessee is going to make to get the lease liability. Okay, but if you come to decommission costs or any other things, you use the discount rate of the lessee. So 11% is for the lease, and the decommission cost, we use the discount rate or the cost of capital of the lessee. That is the 12%. So now I hope I've answered your question.
Thank you.
All right. So the total is what? Right of use.
126.17.
Yeah. Can we read it again?
126.17.
126.17. Okay. So these are the initial figures that we have. How do we subsequently measure this? Okay. So the subsequent measurement, which is after this, what do we do? So the subsequent measurements, we take the lease liability. The lease liability was what? Was discounted. So this is the amount that we are currently owing the people, but we agreed that we are going to pay them 11% at the end of every year. So the 2020 year, we have to find the finance cost. Okay, so the finance cost is calculated as the finance cost is calculated on the lease liability. So we have the lease liability at start. Lease liability at start was 85.6 85.32. So that is the amount that we are currently owing the people. So 85.32. Then we calculate our interest because we agreed that we are going to pay them interest at this one. So this will be 11% on the 85.32. So it's just like you are going to the bank to take loan. So currently you are owing the bank 85.32 for this year. So you are paying interest of 11%. So what will be the finance cost on that?
$9.39.
So 9.39. So what will be the total amount that you are going to be owing them for 2020 year?
94.71.
So 94.71. So this one is for this will be balance carried down, which is for the year. So these amounts, it is the next year that you are going to pay 38.5 out of it. So this is the liability for this year, and this is the finance cost, which will go to profit or loss. Okay, let's come to the right of use. What will happen to the right of use? The right of use will be depreciated because it's an asset. So we count the right of use. The right of use will be depreciated because it's an asset. So we depreciate the right of use, which will be the amount, the initial amount, which is 126.17 divided by the lease period, which is 3 years. Okay. Last time I was saying that the lessee has a right to either choose cost model or revaluation model for the right of use. So they can decide to carry the right of use, which is an asset, using the revaluation model in accordance with what? IAS 16. Or they can use cost model. But mostly we use the cost model. But there can be a question where the lessee will be using a revaluation model for the right of use because the right of use is an asset. So they can decide to use a revaluation model or a fair value model for the right of use. If that is the case, you have to account for the right of use as the way we do the accounting for what? Property, plant, and equipment under IAS 16 when the company is using revaluation model. What will be the depreciation for each year?
40.06.
40,
Two.
42.06. Okay, or 42.1. We can make it like that. There's no problem. This will also go to profit or loss as depreciation. Okay. What will happen? We have to also account for the decommissioning cost. So the decommissioning cost was present value. So what we do is that at the end of every year, we increase it. So we count to the decommission cost, then we calculate the finance cost or the unwinding element. This must be unwinded. So we calculate the finance cost of the decommissioning cost. So finance cost will be equal to the discount rate of 12%, 1.12 times the initial amount, which is what we have added there, is 2.85. So that will be 2.85 million. So what will be the finance cost? What will be the finance cost relating to the decommissioning cost?
0.34.
0.34. So your provision, which is a liability, will now be the 2.85 plus 0.34. And this will be sent to statement of financial position as a non-current liability. So they are asking us to show the extract. We have done the calculation. Let's show the extracts now. Let's show the extracts now. So the extracts will be, let's come to statement of profit or loss. So for 2020, that is what they are asking us. We are going to have a finance cost, and the finance cost will be the 0.34 plus that of the lease liability, which is 9.36, I'm sure, which is 9.36 or 9.39. Okay, I was somehow closer. Okay, so 9.39. So 9.39. So what will be the total amount? Then we count to
Nine 9.73.
okay. Then we count to depreciation 9.73. So depreciation, we have done a depreciation figure already. That is
06.
42.06. Okay, so 42.06. So this is for the statement of profit or loss. Let's count to statement of financial position. So what are we going to do? Statement of financial position, extracts, this one. So the company is going to recognize an asset, which will be a non-current asset, which the name will be right of use, and that will be the initial value of the asset minus the depreciation. So let's look at the initial value of the assets. The initial value was 126.17 minus 42.06. So the asset will be showed at its carrying value. Then we count to liabilities. So the liabilities, we can have, the liabilities, you can try to make them non-current liability and current liability. So let's count to current liabilities. So the current liability, we are going to have a lease liability. That lease liability of 38.5, because that is the amount that you are paying immediately at the beginning of what? The next year. So this value will be paid at the beginning of 2021. So we are doing this at the end of what? 2020, which is 31 December. So 31 December and 1st January, they are treated at the same day. So this will be the lease liability as a current liability. Let's count to the non-current liability. What will be the figure for non-current liability? For lease liability, it will be the value that we are currently owing, which we are going to pick from this side. Okay, that is 94.71. 94.71. Then we take the 38.5 from it. That will give us the non-current value of the lease liability. Under the non-current one again, we bring what we call the provision, which is a decommission cost. So the provision.
Hello, sir.
Yes, Senior.
With the lease liability, the current liability.
Yeah.
But I thought to find the present value for the 38.5.
The 38.5. Yeah, we find the
Yes.
present value, but that is the next year. The next amount that we are going to pay is how much?
Supposed to pay in 2021 the 38.5.
38.5, isn't it? Okay. So you are going to pay 38.5 out of the amount that you are currently owing. So we don't do anything as the present value or the future value of the 38.5. The 38.5 will be paid on the next day. Today and the next day. They are just like the same day. So you are going to pay 38.5, which is the same, which at the same time is the present value. So we are doing this at the end of the year, not the beginning of the year. We are showing these things at the beginning of the year, not at the end of the year, not the beginning of the year. So if it should be at the beginning of the year, that is why the value for 38.5 will not be the same as 38.5, because we are going to pay this amount in a year time. But the 38.5 will be paid the next day out of the 94.71 that you are owing. So it will still be 38.5, which is the present value. Senior, I hope I've answered your question.
Okay.
No, it's a question. I hope I've answered your question. It's supposed to be yes or no, not okay. All right.
I'll get back.
You said?
I'm okay. You've answered the question.
Okay, thank you. Let's come to the provision. What will be the value of the provision? 2.85 plus 0.34. What will be the total value? So 2.85 plus 0.34. Okay, what will be the total value of the provision there?
3.19.
3.19. So that is all. We are done with this one. That is all about this particular question. So you find your right of use the figure, then we put it there. We find the non-current value of the lease liability, which is 94.71 minus 38.5. Then you put it there. Then we move on. Okay. So this is all about this question. Then we take the next major topic, which will
The
be
right of use is
okay.
84.11.
Okay, let's put those figures there for the sake of my people.
0.11.
84.11. Okay. The lease liability.
Is 56.21.
Okay. 56.21. Okay. All right. So this is all about this question. Let's move on to the next one. The next major topic.
Sir,
Yes, Ina.
please, I want to ask you the decommission cost.
Yes, please.
It was 3 years and we bring it to present value as of today.
Yes, please.
So as you are saying that unwind, are we not deferring the 3 years cost to so that then they will come and get zero? Assuming it's 3 years and we have discounted to present value today.
Okay.
So as we unwinding, are we not taking it gradually every year up to the time that it will be out without any?
The amount that you are going to pay at the end of the third year is 4 million.
At the end of the
third year is 4 million.
4 million. Oh, okay.
So we are saying that we want to start providing for that particular money today. So it means that we have to put aside certain amount of money. So what we do is that we just present value this. At the end of the third year, we have to get a 4 million. So what do? We have to be increasing the present value at the end of every year so that at the end of the third year, we have our 4 million. So that is what we are calling the unwinding. So at the end of every year, you increase the balance on the provision account.
Okay.
All right. All right.
Thank you.
Okay. Let's look at another topic, which is this one you can see it in financial reporting, at the same time, corporate reporting. Okay. So that particular thing is what we call sell and leaseback. Sell and leaseback. Okay. All things being equal, you have to see leasing as a source of what? Business finance. So you have to see leasing as a source of what? Business finance. Because why do we lease? We need money. Okay. So leasing is a source of business finance to companies.
Hello, sir.
Yes, please.
Good morning.
Yes, please. How are you?
I'm fine. Please, can you put it on the initial recognition? I just joined, so I wasn't able to copy that one. I
Oh,
want
this.
to take a picture.
Okay, I'll even send it to the page. So I will share the distance, but don't worry. Let's take it. The initial
Yeah.
recognition. Okay. So what I will do is I will just pause the recording so that the time will not be going. Okay. So sell and lease back. Sell and lease back. Okay, the company, we are saying that we need money, but we still need the assets. We need money, but we still need the assets. So what do? We need money. We need money, but the assets is still important to us. So what we do is that we sell the asset to someone and enter into agreement with the person to lease the asset back and use. So we have sold the assets, but we have entered into contract to take the asset back on lease terms. That's what we call the sell and lease back. Okay. Before you do the accounting for the sell and lease back, you first have to determine whether the transaction constitutes a sell. Whether the transaction constitutes what? A sell. The movement of the asset that you are giving to the person. Can we classify that particular transaction as a sell, or it cannot be classified? So what we have to do is that you have to determine whether the transaction is a sell or not. How do we determine that a transaction is a sell? This will be determined in accordance with IFRS 15. Revenue from contract with what? With customers. You can only have a sell, or you can only recognize a revenue when the risks, the maintenance, ownership, control associated with the asset has been transferred to the third party or has been transferred to the customer. So if there is a sell and lease back, the first question that you have to ask yourself is that, can this particular transaction be recognized as a sell? How do you say it's a sell? If the ownership, risks, maintenance, and everything associated with the asset has been passed on to the third party or the customer, then we say that that is a sell. But if ownership, risks, and all those things associated with the asset are still with the what? With the original owner, that is not a sell. So we first have to determine whether the transaction constitutes a sell. If the transaction constitutes a sell, then it must be accounted for in accordance with what? IFRS what? 16 leases. That is, the transaction is a sell.
Sir.
Yes, Senior. They wanted to say something, but I muted you. So if you can unmute yourself and ask the question.
Sir,
Yes, Senior.
please, the question that we just finished right now,
Yes, please.
yeah, I think we didn't do like lease amortization table whereby we will factor the payment in advance because as we said, no, the 35,000 that we paid, it was payment in advance.
Yes, please.
So I want to find out whether we have to do amortization table to ascertain.
Okay. The amortization table is done when you are asked to do the computation for more than a year.
Okay.
So you can see that indirectly I've done that. So I've done the amortization table, but this is the amortization table. I've done it for only 1 year.
Oh, okay.
Okay. But if they ask you to do it for 2020, 2021, 2022, that's why you do the table to make everything simple.
Okay.
Okay.
Thank you very much.
So the amortization table, you can also start by this. You can start with this one. So you start with the lease liability as 35 plus 85.32. This is the amount that you're supposed to pay for the assets, but you have already paid 35. So it means that before you charge the interest, you are going to take the advance payment, which I've already taken, and I have the 85.32. So this is the amount that I'm owing. Then I will charge the finance cost. Then if you go to the next year, then you take this value and you subtract the lease rentals, which is the 35.5 for that year before you charge the interest. So that is the lease amortization table is always for a computation that is going to be for more than a year. So if it is only 1 year, you can just show it like this and move on. All right, senior.
Okay, yo.
Okay, all right.
Thank
Okay. Okay. So the sell and lease back, I'm saying that the first thing you have to ask yourself is determine whether the transaction is a sell. Okay. So you determine whether the transaction is a sell or constitutes a sell. Okay. So if you find out that the transaction constitutes a sell, then you now account for this one in accordance with the provisions of the 16 leases. That if it is not a sell, if it is not a sell, if it is not a sell, you will still continue, the 16 will still apply, but the lessor will still be having the asset. Okay, so if it is a sell, it means that ownership has been transferred to the customer. So we still account for this one, like we still account for it under the provisions of the 16. The 16 give us a provision for the sell and lease back. Okay, if you count to not a sell, okay, you're not going to do anything to the asset. But if it is a sell, you are going to de-recognize the asset, the lessor, the original lessor, de-recognize the asset, recognize a right of use now, lease liability and those ones. If it is not a sell, it means that the amount that the lessor has taken from the customer will be treated as a loan, because you are saying that you are selling an asset, but still the asset is in your possession, you are still using the asset. It means that you just use the asset as a collateral security to take loan from the person. So you are going to recognize the amount that you have taken from the customer as a loan, and you continue what? Recognizing the asset as the way you are doing it before you took the money from the person. So if it is a sell, then we come to the provisions of the 16, where the lessor will de-recognize the asset and now account for the asset as what? As lessee accounting. But if it is not a sell, the amount that the company has taken from the customer will be treated as a loan, will be treated as a loan. All right, let's come to if the transaction is a sell. If the transaction is a sell, what do we do? If the transaction is a sell, the first thing is the owner have to first de-recognize the assets. So de-recognize the assets because the asset has been sold. They will de-recognize the assets in their books at their carrying value. Then they will now recognize right of use because they are going to take the asset back. They recognize right of use because they'll take the asset back. They will also, how do we recognize the right of use? Okay, so the right of use, we look at how to calculate the right of use. We look at how we calculate the right of use. So the carrying value, the carrying value of the asset is this amount, and the present value, the minimum value of the lease payment is this one, and the fair value of this. So it means that the carrying value of this one, the minimum lease payment that you are going to pay, you are trying to maintain that value of the asset. So we look at how we calculate the right of use. Right of use is calculated as the present value of the minimum lease payment divided by the fair value of the asset times the carrying value. That is the right of use. So you are going to sell the asset at the fair value. Okay, but out of this fair value, you are maintaining this portion of the asset, which is the present value of the minimum lease payment. So out of the carrying amount, how much are you transferring to the customer and how much are you keeping out of the carrying value? That is the present value over the fair value, that is the carrying value. That is how we calculate the right of use. The minimum, you will now recognize a lease liability. So the lease liability, they will now recognize lease liability, which will be accounted for, or which will be computed and accounted for like the way we account for any other lease liability. Okay. Then the company will also, maybe they are going to receive cash from the sale. So they will also recognize the cash as this. Then they will now recognize a profit. They will now determine profit on the sale. Okay, the profit on the sale is not the actual profit. So you determine profit or loss on the sale. Okay, so the profit or loss on the sale is being determined like this. Let's take some assumed figures. Let's see that the carrying value of the asset was 10 million. The asset was sold for 15 million. Okay. What will be the profit on the what will be the profit on the sale? All things being equal, what is the profit?
5 million.
5 million.
All right. You are going to recognize this 5 million it's if you have given the asset to the person and you are not taking the asset back. Okay. So all things being equal, 5 million should have been the what? Should have been the profit. But you are using this asset back. It means that you are retaining portion of the asset. If you are leasing the asset back on a finance system, it means that you are maintaining some portion of the ownership of the asset, because during the lease period, you are going to be seen as the legitimate owner of the asset. So out of the carrying value of the asset, what portion are you retaining? Because there is a part of ownership that is still in your hands, which is the right of use. So what portion are you retaining? It means that the asset has been sold, all right, but not all the right has been transferred to what? To the customer. You are still maintaining part of the rights. So what is the right given to the customer? You only recognize profit to the proportion of the rights that you have been transferred to the customer. So what you do is that you look at the right of use, which is the ownership that you are retaining out of the asset. Then you look at the carrying value. So the carrying value of the asset is this amount. I'm retaining this part of the right. So what will be the right that I've transferred to the customer? So you recognize the profit on the what? On the right that has been transferred to the customer. And the profit is calculated as this. The profit that you are going to recognize is calculated as the carrying value minus the right of use over the carrying value times the what? The normal profit, which is the 5 million year. So the normal profits or the profit on the sale, which is this one. This can also be calculated like this. If you're using the fair value, this can also be calculated like this. The profit can also be calculated as the fair value minus the present value of the lease payments divided by the fair value times the normal profit. Any of them that you want to use, there is no issue with that. So that's how we recognize the profit. All right. So this is all about this question. You are the legitimate owner of the asset. You have sold the asset, so you have to de-recognize the asset from your books. Then you now enter into a lease agreement to lease the asset back. You have to now account for the asset in accordance with what the leasing accounting. So let's pick a question. Then we do with that. And we also look at sometimes the sale will not be at fair value. Let me talk about that one before we move on. Okay. Under any circumstance, the asset should be sold at its fair value. Whatever happens, the asset should be sold at its fair value. Okay. So if the fair value of the asset is 15 million, the asset should be sold at what? 15 million. But what will happen? It can happen that the asset is sold below its fair value. The asset is sold below, or the asset is sold more at a value that is higher than the fair value. So the fair value of the asset is 15 million. The fair value of the asset is 15 million. So let's determine the fair value of the asset is 15 million. It's 15 million. Okay. But the asset has now been sold at 14 million. It means that it has been sold at 1 million less than what? The fair value. The asset can be sold at 17 million, which is what? 2 million above the fair value. How do we account for these two? Okay. Under any circumstance, the asset should be sold at fair value. Whatever happens should be sold at fair value. But if the asset is sold at a value less than the fair value, it means that they have sold the asset at what? It was 15 million, but they sold it for 14 million. They have sold it at a value which is 1 million less than the fair value. So the fair value of the asset is 15 million. That is the value at which the assets have to be sold. But the customer is giving the company 40 million. 1 million is short. This 1 million will be accounted for as an advance payment, because under any circumstance, the asset should be sold at what? Fair value. So the assets should have been sold at fair value, but you are telling the customer that, okay, we want to pay 1 million in advance, or we want to pay the 1 million as initial deposit. So give us only 14 million. So this 1 million, which is the shortfall, will be added to the right of use, like initial deposit or advance payment. So the 1 million will be added to the initial value of the right of use. If it is sold at 17 million, that is a value above the fair value. It means that this is sold at a value above what? Value of 2 million above the fair value of 15 million. What does this mean? This means that you should have been given 15 million, but you are giving 17 million. You are giving additional loan of 2 million. So this will be classified as additional loan, which will be accounted for under IFRS 9, financial instrument. It will be classified as a financial liability. The excess payment will be treated as what? A loan. You are taking a loan from what? From the customer, because the value that they should have paid for the asset is 15 million, but you have taken 17 million. So they have granted you additional loan facility of 2 million, which will be accounted for under IFRS 9, which is what? The financial instruments. So the asset, that 2 million will be classified as a financial liability, and it will be accounted for under the provisions of the IFRS 9. Okay, it's 1 hour. I'll end the meeting here. Then we go for a break for like 5 minutes. We come back, then we continue with the sell and leaseback. We solved 2 questions on sell and leaseback. I'm sure one will be the normal sell and leaseback. One will be on what? Advance payment, where the asset will be sold at a value less than what? The fair value, advance payment. There's a question on which the asset will be sold at a value higher than the fair value. There is a question there. But if I should solve all the questions here, I don't know the question that I'll be solving during normal class. So I'll leave some of them out, and I'll solve some of them during normal class. So I'll see you after 5 minutes. Thank you.